Welcome back to the deep dive. If you are looking at the stack of source material we have in front of us today, you would be forgiven for thinking we're covering 5 different academic degrees simultaneously.
Chuckles. Yeah, it's quite a pile.
We are talking about a massive, diverse intellectual terrain. I mean, we have a stack of sources that leaps from uh, ancient moral philosophy and the very foundation of character.
All the way into highly specialized tax law.
Exactly. Complex financial modeling
Yeah.
and even the specific audit requirements for a cash-heavy operation like a hotel. It's a lot.
It truly is an intellectual expedition, not just a deep dive. It's a journey across what, on the surface, seem to be completely unrelated disciplines. Ethics, corporate structure, advanced financial control.
Project assurance, regulatory compliance, the whole 9 yards.
Right.
And that, for you, the learner, is really our mission statement today. We are not just summarizing these fields. We are trying to extract the core actionable knowledge from them and stitch them together.
Find the common thread.
Yes. The goal is to provide a comprehensive, structured understanding of the underlying systems, both the technical and the philosophical, that govern sound business conduct and ultimately define organizational longevity and success.
Precisely. We need to zoom out and see how these specialized parts form a coherent whole. If you look at the snapshot of the sources, we start with the philosophical underpinnings of professional behavior in the ethics section. That's the internal compass.
And then we move to the external architecture, the rules of business, collaboration and structure. That's in the partnership accounting material.
From there, we get into the analytical engines.
The technical tools managers use to measure risk and performance. That's where we'll unpack concepts like leverage and marginal costing.
And finally, we ground it all in the crucial control environment, looking at project assurance tools and the dense regulatory landscape, including complex topics like customs valuation and the workings of the alternate minimum tax.
So what does this all mean? I think it means these areas, which might seem entirely separate if you study them in different courses, they actually feed into the overall health and accountability of an organization.
Oh, absolutely.
If you are technically brilliant in finance, but you lack that ethical groundwork, your brilliance becomes a liability.
They are the very DNA of sound business practice. As we unpack this, we're going to see how specialized areas define both the structure and the responsible conduct required for a sustainable business model.
Okay, let's unpack this and see how these specialized areas define the DNA of sound business practice.
Let's do it, starting with that fundamental layer of character.
Right. Let's start where the journey begins, with the fundamental concept of ethics. You mentioned it's derived from the Latin word ethos, meaning character. This isn't just fluffy sentiment, is it? It's a rigorous social science.
It is indeed. Ethics is the social science dedicated to defining concepts like right and wrong, moral and immoral behavior. Crucially, it governs conduct in institutions, organizations, and the broader socioeconomic system.
So it's about more than just personal belief.
Much more. The key distinction to remember is that ethics applies to actions taken deliberately by an individual or a group that have an impact over others. It is the framework for judging intent and consequence.
Okay. And to make sense of this massive field, philosophers break it down into 3 core pillars of ethical theory. We should probably define these frameworks because they dictate the level at which we approach a moral or business problem.
Absolutely. The foundational level is metaethics. This is highly theoretical. It addresses the meaning and reference of moral propositions. Questions like, what is the meaning of good? Or how can we determine the truth value of a moral statement?
So it's almost like the linguistics of morality.
That's a great way to put it. It's the linguistic and conceptual structure of morality itself.
Okay, so if metaethics is defining the rules of the debate, then the next step is normative ethics, which sounds like the application layer.
It is the prescriptive layer. Normative ethics focuses on determining the moral course of action for a specific situation. It seeks to establish standards or norms that guide right conduct. It answers the question, what should be done?
So things like utilitarianism would fall under this.
Exactly. Utilitarianism, which seeks the greatest good for the greatest number, is a classic branch of normative ethics.
And finally, bringing it right down to earth, we have applied ethics.
This is where theory meets the road. Applied ethics deals with using those moral outcomes and normative frameworks in practical situations.
Yeah.
How individuals in society or an organization or a business use their moral outcomes in their work or family life, that's the main area.
And the source material breaks this down even further.
It does. We have decision ethics, clinical ethics, social ethics, and, most critical for us, professional ethics. And within that, accounting and auditing ethics are prime examples, defining how experts handle conflicts of interest, confidentiality, and truthfulness.
So it's the difference between a philosopher debating the concept of duty, which is meta-ethics,
Right.
and an auditor deciding whether to report a fraudulent activity. That's applied ethics.
Precisely. And in the business environment, every organization needs a pervasive framework for conduct, especially since they deal with so many different interest groups: investors, employees, customers, regulators, the community. This framework, therefore, it has to be robust.
That brings us to the core ethical principles in business. These principles are what the formal codes of conduct are built upon, right?
They're the non-negotiable standards. You have principles like integrity, being straightforward and honest in professional and business relationships. Then objectivity, not allowing bias, conflict of interest, or undue influence to override professional or business judgments.
And then the obvious ones like confidentiality.
Of course, confidentiality and maintaining professional competence and due care. These four, coupled with professional behavior, form the foundation of any sound code of conduct.
Speaking of gold standards, let's pivot to a highly influential set of rules established in the public sphere. The 7 principles of public life. These are often used as a template, even in private organizations, aiming for the highest standard of governance.
They are globally respected. These were set out by Lord Nolan's Committee on Standards in Public Life in the UK back in 1994. And while they were established specifically for public servants, from civil service to local government, they provide a phenomenal, tangible template for high-level ethical conduct in any leadership role.
Let's just quickly run through them because they are so foundational to accountability.
Sure. First, selflessness. Decisions must be made solely in terms of the public interest. This immediately cuts against personal gain or favoritism.
Straightforward enough.
Second, integrity. Public servants must not place themselves under any inappropriate financial or other obligation to people or organizations that might try to influence their work. They must actively declare and resolve any conflicts of interest.
That emphasis on resolving conflicts is critical. It's not just about knowing they exist.
No, you have to act on it. Then we have objectivity.
Making decisions based on evidence.
Exactly. Objectivity mandates that decisions must be impartial, fair, and based on merit, using the best available evidence without discrimination or bias. This is the bedrock of fair process.
The number 4 is accountability.
They must be accountable to the public for their decisions and actions and submit themselves to the necessary scrutiny required to uphold this accountability.
5th is openness.
This one's about transparency. Decisions should be taken in an open and transparent manner. Information should only be withheld if there are clear and lawful reasons for doing so. This is how you build public trust.
And the final 2 feel very character-based.
They are honesty, meaning a duty to declare any private interests relating to their public duties and to take steps to resolve any conflicts. And finally, leadership. This means you must actively promote and exemplify these principles in your own behavior and be willing to challenge poor behavior wherever it occurs.
But it's not just about following the rules yourself.
No, leadership is the act of promotion, not passive compliance.
I think that concept of leadership and ethics is the perfect bridge to our next point, the complex relationship between laws and ethics. Because just complying with the law, in theory, that's not enough.
That's the key synthesis. They are similar in that both guide human conduct for civilized social existence and both enforce a sense of right and wrong. But they diverge fundamentally in their nature and scope.
Okay, let's unpack this. Laws are external and enforced. That's the big one.
Exactly. Laws are external obligations, uniformly applied and enforced by the state through sanctions and penalties. That's retributive justice. Ethics, conversely, refer to a set of internal norms that guide our personal compass.
So they can be different for different people.
They can vary from person to person, they change more frequently than codified laws, and crucially, they are generally not enforceable by the state. You don't get arrested for being selfish unless that selfishness violates a specific statute.
But laws often originate from some kind of ethical consensus, right? For instance, the legal principle of equality before the law is an expression of the ethical value that all human lives are equally valuable.
That's the intimate connection. Laws shape ethics, and ethics shape laws. However, laws alone are inherently insufficient to promote fully ethical behavior because the law can never be so exhaustive as to cover every single scenario possible.
So we have what you might call the discretion gap.
The discretion gap is huge. Laws are broad statutes. Their application requires judgment and discretion at the micro level. For example, a law might prohibit bribery, but ethics governs the gray area where an excessive gift might influence future discretion, even if it doesn't meet the legal threshold for a crime.
So laws are the floor.
Laws set the floor, but ethics define the ceiling of acceptable behavior.
You cannot have a strict law to scrutinize every small act of corruption or self-dealing that occurs outside the view of regulators. You need that internal compass.
And we often see unethical practices persist even with strong laws in place. So, for sound business conduct, laws and ethics must go hand in hand. The external rulebook provides the minimum standard, but the internal compass, guided by principles like integrity and objectivity, fills that crucial gap of discretion.
And that promotes long-term trust and sustainability.
Exactly.
From the internal foundation of character, let's pivot sharply to the external legal foundation of collaboration. If you decide to go into business with someone, you often form a partnership. So let's look at partnership accounting fundamentals.
A partnership is fundamentally a contract. It's a formal relationship between two or more individuals who contribute resources, skills, or labor to operate a business with the expressed intent of sharing profits or losses.
And its features dictate the level of risk and control for everyone involved.
Absolutely. First, the agreement. It can be oral, but it's almost always documented in a partnership deed, which governs the terms of profit sharing, salaries, interest on capital, and, dispute resolution.
And then something that's critical for risk management: mutual agency.
Right. Each partner acts as both a principal and an agent for the firm. This means one partner's binding actions, as long as they're within the scope of the business, are the firm's liability, and thus the liability of all partners.
Which brings us to the defining risk: unlimited liability. Let's pause here and really emphasize this for the learner. This is huge.
This is the fundamental difference between partnership and corporate structures. Partners are personally liable for the firm's debts. If the business fails, the personal assets of the partners, their homes, savings, investments, can be seized and used to settle the liabilities.
That's a massive personal risk.
A very high risk. It necessitates careful selection of partners and a highly detailed deed.
Okay, then we have profit loss sharing and non-transferability.
Sharing is dictated by the deed. If the deed is silent on the matter, then the sharing is equal. Non-transferability means a partner cannot simply sell or transfer their share to an outsider without the explicit consent of all the other partners.
So it's a closed-door relationship.
Very much so. It reflects that high degree of personal trust inherent in mutual agency and unlimited liability.
Given that high personal risk, let's look at the different types of partnership structures that mitigate or shift that risk profile.
The standard model is the general partnership, where all partners share unlimited liability and participate actively in management. Then you have the limited partnership, or LP. This structure is a hybrid.
How so?
It requires at least one general partner who has the unlimited liability and manages the business, and one or more limited partners.
And the limited partner is exactly what it sounds like.
They are essentially passive investors. They contribute capital, they do not participate in management, and crucially, their liability is restricted only to the capital they invested.
So they provide funding without the crushing personal risk.
Exactly. It makes the LP structure very attractive for capital raising.
We also have the structural flexibility of time-bound agreements.
Yes, the less permanent structures. A partnership at will exists until any partner decides they want out, at which point it can be dissolved upon notice. A particular partnership is formed for a specific, singular, venture-like building, a single high-rise, and it dissolves automatically upon the completion of that project.
That flexibility is great, but life happens. Let's talk about transitions. When someone enters, leaves, or dies. These are the moments where the partnership must prove its integrity through its accounting adjustments.
The entire process revolves around ensuring fairness and accurately valuing the existing business before the change takes effect. When a new partner is admitted, several things must be adjusted. The profit-sharing ratio is obviously altered.
But before the new partner is truly in, they have to pay for the value that's already been built up, which includes goodwill.
Exactly. There must be a goodwill adjustment. The incoming partner must compensate the existing partners for their share of the firm's established reputation and value, which we call goodwill. This is often a cash transaction or an implied capital adjustment.
Okay, so they contribute capital, and then what about the balance sheet itself? Does that change?
The balance sheet must be cleaned up. There must be a revaluation of assets and liabilities to bring them up to current market value. This ensures the assets and corresponding gains or losses are allocated to the old partners before the new partner is admitted.
And what about existing profits?
Similarly, any existing reserves and accumulated profits must be distributed among the old partners. Failure to do this would unjustly enrich the new partner at the expense of those who built the reserves.
And the reverse situation, retirement or death? This has to be handled with the same rigor, I assume.
It does. It involves calculating the exiting partner's full share, which includes capital, reserves, their share of goodwill, and any revaluation profits up to the date of exit or death.
And how is that paid out?
The settlement can be immediate or in installments. For death, the amount is settled with the legal heirs. And the source wisely highlights the role of partnership insurance proceeds here.
Let's elaborate on that insurance piece. If a partnership takes out a joint life policy on all partners, why is that an essential risk mitigation tool for a partner's death?
Because a partner's death often requires a massive, immediate liquidity event to pay off the legal heirs without liquidating core business assets.
You don't want to have to sell the building just to pay out a deceased partner's family.
Exactly. The insurance proceeds are structured to be available specifically for this settlement, minimizing disruption to the ongoing business operations and ensuring the remaining partners don't have to scramble for cash to maintain the firm's continuity.
That is a critical linkage between structure and financial planning. Now let's clarify the two critical end states that often confuse people. Dissolution of partnership versus dissolution of the firm. This distinction matters greatly to regulators and creditors.
This is fundamental. Dissolution of partnership means the relationship agreement between the existing partners is terminated and a new one is formed. The business itself continues operating.
So this is what happens when someone retires or a new partner joins.
Precisely. The old contract is gone, but the entity lives on.
The business stays open, it just has a new internal contract.
Correct. Dissolution of the firm, however, means the business stops operating entirely. The operations cease, assets are sold, liabilities are settled, and the residual balance is distributed. This is the official end of the business.
And when a firm dissolves, the methods are defined by agreement, compulsorily, like if the business becomes illegal or all partners become insolvent.
Or by court intervention due to misconduct, incapacity, or continuous losses, or simply on notice for a partnership at will.
When that dissolution occurs, there is a very strict, legally mandated settlement order that prioritizes creditors.
It has to. First, all external debts and liabilities must be paid in full: suppliers, banks, outstanding taxes. You pay outsiders first. Second, you repay loans from partners. Third, you return the partner's capital contributions.
And this is where that unlimited liability can really bite. If the firm's assets are insufficient after the first two steps, the partners must individually contribute their personal wealth to cover those external debts.
Absolutely. Only if there's a residual balance left after covering external debts, partner loans, and returning capital is that final amount distributed among the partners according to their profit-sharing ratio.
Moving to the opposite of dissolution. If the business is successful and wants to grow through combination, we talk about amalgamation.
Amalgamation occurs when two or more partnerships combine, effectively merging into a new, larger entity. The drivers are usually expansion, avoidance of competition, resource pooling, and achieving synergistic efficiencies.
A pretty complex process, I'd imagine.
It's a complex accounting exercise involving the full valuation and settlement of the old firms and the creation of a brand new comprehensive partnership agreement for the merged entity.
Okay, let's shift slightly from partnerships to the corporate world, focusing on equity instruments, specifically the redemption of preference shares. This is tightly regulated, generally limited to a 20-year maximum redemption period. Why the strict regulation?
The regulation is purely about creditor protection. When a company issues shares, that capital is the ultimate buffer for creditors. If a company simply uses retained earnings to buy back or redeem shares, it diminishes that buffer.
So there are rules to stop that.
Yes. Therefore, when preference shares are redeemed out of profit, an amount equal to the nominal or face value of the shares being redeemed must be transferred to the Capital Redemption Reserve, CRR, account.
So the CRR mechanism effectively takes a chunk of distributable profits and locks it into a reserve that cannot be used for dividends. It maintains the capital base.
It acts as a surrogate for the capital being returned. It prevents the company from eroding its capital structure while rewarding shareholders with the redemption.
And the rules are strict.
Very strict. The CRR cannot be created from unrealized capital reserves, which means reserves based on paper gains are excluded. Furthermore, if the company pays a premium on redemption, paying more than the nominal value, that premium must be met out of the security premium account or the profit and loss account. This ensures the capital base remains sound and resilient.
We've established the ethical rules of engagement and the legal structure of collaboration. Now let's get into the analytical tools managers use internally to measure performance, manage costs, and make high-stakes strategic choices. We start with marginal costing, often called the manager's secret weapon.
Marginal costing is fundamental to decision-making because it radically simplifies the cost structure. It's a technique where only variable costs, costs that change directly with production volume, are charged to the product cost.
And fixed costs.
Fixed costs like rent or standard salaries are treated as period costs and charged against the aggregate contribution for that period.
Why is this separation so useful? What does it let a manager do?
It allows management to quickly understand the cost of producing one additional unit and how much revenue that unit generates above its variable cost. This is essential for pricing, production mix, and capacity utilization decisions, which is why it's also known as variable costing.
The source material is defined by formulas. Let's build the model step by step. The foundation is contribution, C.
Contribution is simply sales revenue minus variable cost. This is the crucial metric, as it represents the revenue remaining after covering the direct costs, which is then available to contribute toward covering fixed costs and generating profit.
So if you don't generate contribution, you're losing money on every single unit you produce.
You're going backwards with every sale.
Okay. Next, we determine how efficiently we generate that contribution relative to revenue, the PV ratio.
The profit volume ratio is contribution divided by sales, or CS. It tells a company how much contribution they are earning per dollar of sales. For example, a 40% TV ratio means 40 cents of every dollar of sales is available to cover fixed costs and generate profit.
So if a manager wants to improve their PV ratio, what are their levers? What can they actually do?
3 primary levers. Increase the selling price if the market allows it. Reduce the variable cost. For example, find cheaper materials or more efficient labor. Or perhaps most strategically, alter the sales mix toward products that have a naturally higher PV ratio.
That's a constant management focus.
Non-stop.
All this calculation ultimately leads to the most important checkpoint, the break-even point, BEP.
The BEP is the point of zero profit, zero loss. Total contribution exactly equals total fixed costs. Graphically, it's where the total sales line and the total cost line intersect. It tells you the absolute minimum volume or revenue you must achieve just to stay afloat.
And once you cross that threshold, you measure the business's health using the margin of safety.
The margin of safety is the excess of actual or budgeted sales over the break-even sales. If your margin of safety is $5 million, that means sales can drop by $5 million before you start losing money.
So it's a direct measure of the resilience of the business.
Exactly. It measures the soundness and resilience against economic downturns or competitive pressures. A larger margin of safety means the business is safer.
And for visual interpretation, we have this specialized concept of the angle of incidence. What's that?
On the break-even chart, the angle of incidence is the angle formed between the sales line and the total cost line, radiating outward from the BEP. A large angle signifies that for every dollar of sales beyond the BEP, the company is generating profit quickly.
So a big angle is a good thing.
A large angle of incidence coupled with a large margin of safety indicates a very robust and highly profitable business structure.
Let's move to application. This isn't just theory. Give us an example of how marginal costing drives a crucial decision like product mix.
Certainly. Imagine a manufacturer produces 2 products, A and B, using the same limited machine hours. Product A has a high selling price but also high variable costs, yielding a $10 contribution per unit.
Okay.
Product B has a slightly lower selling price but extremely low variable costs, yielding a $12 contribution per unit. The marginal costing principle dictates that the optimal product mix should maximize the aggregate contribution.
So you'd make product B.
Not necessarily. If the limiting factor is machine time, you must produce the product that yields the highest contribution per machine hour. If